Hello friends, today what we are going to see is about the item 5O in table 5 of GSTR9C sales reconciliation. Normally it is considered as a residuary item in the sales reconciliation of GSTR9C. That is, from item 5A to 5N are all specific items, and whenever we deal with item 5O, we used to say whatever not falling in the above categories will be grouped here and disclosed. But actually, when we see the sales reconciliation in between the financials and the GSTR returns, the major chunk of the financial items go into this item 5O. So we would like to analyze today whether it is a residuary item or really a primary item in the sales reco with financials. Okay, friends. So we'll start with a disclaimer that whatever views we discuss here are the personal views of the presenter and does not represent the views of ICAI. The primary objective of this is for educational purposes and not to be misconstrued for anything else. Whatever suggestions given here are only with the aim of achieving improvement and with no other intent. So whoever relies on it will be doing it on their own judgment. So this is the regular table 5 of GSTR9C. What we normally do. We do not want to go into the details of item 5A to 5O as our objective is only 5N as our objective is only to discuss about 5O. Let us see which are all the items are regularly considered by the GST team of the assessee in the regular monthly returns, and we call them as GST. And whichever not considered in the regular monthly GSTR1 returns, but the entries which pass through the financial books, we consider here as financial. So when we see it is turnover as per financials, it is a financial item. Unbilled revenue at the beginning of the financial year, we call all these as GST item because it finds place in the regular monthly GSTR1. So whatever we say here as yes under GST item, these are all considered regularly in the monthly GSTR1 by the assessee. And whichever coming under financial item, these normally find place at the year end in this reconciliation. Though the purpose of GSTR9C table 5 is to reconcile between the turnover between the books, financials, and the annual return, many of the items finding place in this table are regular GST items. So what the instruction says, it says adjustment in turnover due to reasons not listed above. Any difference between the turnover reported in the annual return and turnover reported in the audited annual financial statement due to reasons not listed above shall be declared here. So when the financial items that find place in the regular table 5 are very few, major chunk goes here. So when we see a company of 1,000 crores size, turnover size, there will be a big chunk of some 30 crores, 40 crores, 50 crores lying in this item 5. Anyone will wonder what are all those items, whether GST implication is there or not there. So just to address that, we are dealing here. So when we further dissect what all the items go into item 5.0 as a financial item or as a GST item, let us discuss one by one, which are all added to the financial turnover to arrive at the GSTR1 or the annual return GSTR9 turnover, and whichever items are deducted from the financial turnover to arrive at the annual turnover. Here, when we come the items that are normally added, FI items added, the first item is a damaged stock returns local, it is intrastate returns, and damaged stock returns central, it is interstate sales returns, and damaged stock returns FI. We mean without movement of goods, if we give credit note for some of the returns, which the assessee may consider it not useful to take it back to spend on freight and all, but give the credit note. Okay, all these items come here. As normally, though the assessee is eligible to claim GST and adjust against the GST liability whenever any returns are done, these cases of damaged stock returns normally happen very late. That is beyond the September of the following financial year. That way, the assessee may not be able to claim it in the GST returns. And also, in the case of FMCG companies, where innumerable items invoiced over different periods will be returned back. So for the sake of business, the assessee would have accommodated the customers and take it back and give a credit note. But it will be difficult practically to trace these returns to the original invoices, which may span across 1 year, 2 year, like that. See, in the case of big items like motor cars and all, they will be able to trace from the batch of the product, when it is sold, where it is sold, to whom it is sold, and all that. But in the case of FMCG companies or such like companies, it will be very difficult to trace. So normally the assessees chose to play safe, not to claim the GST and adjust it in the returns. Then comes the sales cut-off reversal at the year end. See, whenever the statutory auditors finalize the company's accounts, they go by the revenue recognition accounting standards, Ind AS 9, or if it is an Ind AS company, Ind AS 18, or if it is a construction company, construction contract company, Ind AS 11, like that. So whenever any invoice is raised at the year end, say 31st March or 30th March, financial year end, but for the sake of complying with the accounting standard, the auditors will find that they do not comply with the revenue recognition. That is, the policy of the company may be to recognize sales when it is received by the customers. Though the company would have invoiced on 31st March around 8 o'clock at night, but it would not have been received by the customer within 31st. So what they do, they normally segregate all those transactions and they deduct from the sales in the grouping schedule. So this is in contrast to what we see in the regular table, an item, unadjusted unbilled revenue. This is contrast of that. There it is unbilled but recognized in GST returns. Here it is billed and recognized, but in the financials it is not recognized. So all these things will have to be added back because it is already included into GSTR1 and the taxes paid. Next comes the scrap sales reclassification done by the auditors at the year end. Normally, it is included into other income or miscellaneous income by the company in the books of accounts, and the auditors will reclass it into sales. Or if they fall as non-operating, then from sales they may reclass into other income. So, but already taxes are paid by the company on these things and included into GSTR1. So we add. This is a case where it is regrouped from sales to other income. So we add back. Next comes a major item. Wherever the company has outsourcing arrangement to manufacture some of its products, what happens there? Normally, some raw material, packing material, semi-finished goods, the company supplies to the outsourced party, and they manufacture and they send back. If it is a case of job work, no issues. It goes with challan and comes back with challan. But some companies prefer to bill them with whatever material they send to them, and they take back the finished product and then sell. So in such cases, there will be the sales would have been taken twice. Once when we say, suppose 30 rupees, it is the raw material SFG cost, we bill that, pay the GST on it. And when the manufacturer, it is coming back at 100 rupees, we take it as purchases. Then when we sell, suppose we sell it at 120 rupees. So 120 rupees as well as 30 rupees, these are the same product. So it is considered twice. What the auditors will do, they will reduce this sale of RMPM SFG from the sales revenue in the grouping schedules. But actually, for GST purpose, it would have been taken as a turnover in the GSTR1. So we have to add back to arrive at the annual return turnover. Next big item comes net sales value adjustment of business promotion expenses. See, in many cases, the companies, to improve the sales, they incur a lot of business promotion expenditure. And wherever they have a price impact, so the auditors will evaluate, and if it is in the nature of reduction in sales price in their view, they will, in the final grouping schedule, reduce that business promotion expenditure from the sales group and reduce the turnover. This happens, suppose in the case of car manufacturing company, they will give business promotions, that is price offers, on the basis of each segment, say compact segment, sedan segment, SUV, luxury car segment. So what they book according to the category of the product category, the business promotion expenditure. So no one will be able to trace it from each GSTN point of view or the state point of view, because they, for the business purpose, they want to know how the products categories are performing profitably or not. So when we come at the year end, and the auditors adjust this in the sales group, when we want to file the returns, do this table 5 reconciliation state-wise for each GSTN, then what we have to decide how to apportion it. So we apportion it on the basis of gross sales done in each state, and reduce it and add it back to the turnover. See, this has got no GST implication, because it is just to reflect what adjustments the auditors have done, and it is purely an FI item. So we add back that. Next comes zero value tax invoices. See, in pharma companies or FMCG companies and all, they may issue free issues, samples, free of cost to the distributors, retailers, and all that. But for complying with GST law, they would have raised a zero tax invoice, paying the tax due on it. So all these things will not find place inside the financial records because it is a zero value tax invoice. So we have to add back to arrive at the annual turnover. Next comes sale of assets. So whenever any asset is sold, we credit to the asset account concerned the sale value. So it will not find place in the turnover of the financials, but we would have disclosed in GSTR1 by paying necessary tax there. So we will add back to arrive at the annual turnover as per annual return. Next comes whatever items so far we have seen what items have to be added back to financial turnover to arrive at GSTR9 turnover. Now we will see some examples of whatever items that will be reduced from the financial turnover to arrive at the annual return turnover. So here the same thing, the sales cutoff reversal. That is according to revenue recognition, whatever the auditors reversed last year or reversed last year would have been credited into financial books this year as turnover. But for GST, we have already offered to tax. So we have to reduce it to arrive at the taxable turnover as per GSTR9. Same case is the rate difference debit notes. There may be debit notes which are raised, which are purely FI item. That is, no GST impact will be there. So for some recoveries to be done from the customer or vendor. So we would have raised some debit note without GST, where there is no GST implication. So those things, since the rate difference account we have already adjusted, we have to reduce here. Next comes a few items which find place, contra items, which find place in both GSTR returns as well as financial books. So this will not come into this reconciliation because they offset. So good stock returns, we would have claimed in GSTR1 by reducing the sales. In the same way, in financials also, we reduce the good stock returns in the sales group. So we need not bring it into, it is only for clarificatory purpose. These three items are discussed. We need not bring into the table 5 reconciliation. Next comes trade discount allowable under GST rules. See, in the case of sales to DMart or Metro Cash and Carry, such kind of big customers, the companies would have already entered into some agreement on price front. If suppose they lift so much quantity in this month, they will give these discounts. So wherever it is already agreed and that discount is allowed, then GST would have been charged or reduced. Okay. So that way it would have come into GSTR1 return, as well as this discount we from the expenditure account head we reduce from the sales group to reflect the correct turnover in financial. So it will not come into table 5 reconciliation as it is a contra item. Similar is rate difference credit notes with GST. Whenever any rate difference credit notes are raised for difference in taxable value, the GST also would have been charged on it. So we would have offered it in the GSTR1 return. And this rate difference normally we add back into the sales group at the year end. So that way it is a contra item. We need not bring into the reconciliation. So what from the discussion so far done we understand is the major chunk of financial items go into the residuary item 5O, which is not the real objective of the table 5 of GSTR9C. So what we can think of is all these FI items, we should provide separate line items without hard coding, blank line items, so that each industry and each company will have different practices and whatever impacting their financials, they can bring in and disclose there. In the same way, deduct items also, blank line items, if it is given without hard coding, it will be helpful to the companies according to their situation and cases, they can disclose it. So this way, what we can conclude is item 5.0 is not a residuary item, but actually a primary item in the table 5 sales reconciliation with financials. As the objective of table 5 is to reconcile with financials the annual return turnover. Okay. So what we can think how this format can be revised, as we just now discussed. We can say this item 5.0 we can split into two. Say 5N, we say FI add items. Whatever we discussed just now, we can give blank subsection 1, 2, 3, 4 subclauses. We can help them fill up there. And whatever deduct items are there, we can say FI less items. And we can give some subsection 1 to 4 clauses, subclauses. So we should give a facility of adding additional line items, say to a maximum of 10 line items in each case, so that it brings out clearly what the adjustments done in financials, so that when the assessing officer sees at the end when the GSTR9C is filed, he will not be perplexed to see in the case of a 1,000 crore company, some 50 crores sitting in item 5.0. He will be wondering whether any GST implication or the items which raise GST liability, whether they are sitting inside. So it is better that we split this. It will help the assessing officer from avoiding unnecessary issue of notices, just to clarify this and convince himself. He need not issue ASMT 10 and the assessee need not reply in ASMT 11 insofar as this item is concerned. It will be majorly non-GST items which will be sitting inside that. It is better we bring that clarity in the table itself, structure of the table. That will help everyone. Be it assessee need not maintain separate workings for this. Whenever it is there, it is on the face of the table. It will save the time of both the people. And thanks for watching this video. Hope it serves the purpose in clarifying the line item 5.0 in detail. We propose to cover such non-regular items in table 14 in the next week, and in the week after, table 12. Thank you, friends.